Greetings from our team at Robare Jones Wealth Management. This is Jack Jones, the managing partner, with our March monthly market update. Before I begin, I want to thank our value clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. We hope to see many of you at our upcoming quarterly investment forum on Wednesday, April the 19th. We expect over 100 in attendance and very much hope to see you there. You should have either already received or will soon be receiving an invitation for you and your guests. So this in honor of Houston Livestock Show and Rodeo that's ongoing right now. You may feel like the rider in this case, and the bucking bronco is the market. As it relates to that, we've talked about this a lot before, that at the top of markets, you feel the best, but you're exposed to the most risk. And at the bottom of markets is when you feel the worst, but there's the best forward opportunity. And kind of connected to that, some concerning news of just yesterday, the Thursday, the 9th, Silicon Valley Bank, stock declined by 60%. Now, this is a very niche bank as it relates to the type of clients they have. Whether there's a contagion effect or not remains to be seen, but that's another headline the markets are digesting. Also digesting is jobs number from Friday. So job growth at 311,000, unemployment rate at 3.6, average hourly earnings up 0.2, annualized up 4.6. That was a lighter number than anticipated. So in this jobs number, you kind of have some things to like in that it's not nearly as hot as the 500,000 jobs in the prior month. There was also some downward revisions, and the average hourly earnings is down or is up by less than expected. So as it relates to the Fed and inflation and interest rates, you could see this arguing for, and we'll talk about this in a second, either a 25 basis point increase when the Fed meets later this month, or a 50 basis point increase. There's still a distortion in the job market, and that there's about 2 jobs available for every job seeker. So that's something that we're continuing to monitor. So far in the first full months of this year, January was a positive month, February was a negative. Going back to 1926, what does it mean if there's a positive January and a negative February? On average, the next 10 months, so the remaining of the calendar year, stocks are up on average about 13%. So inflation's another thing that we're closely following. 9.1 was kind of the peak. 6.4 is still high annualized, but it's much lower than 9.1. And to the extent you want to think about 9.1 as peak inflation, over other peak inflation periods of time, going back to 1926, the next 12 months on average for stocks up 18, on average for bonds up just under 8. So if you think 9.1 was peak inflation, which we're down significantly from, that's positive for stocks and bonds going forward compared to what's happened historically. So the Fed has been actively busy, kind of taming inflation with a lot of rate hikes. Most recently 25 basis points, and there's about a 50% chance that we'll get a half point increase later this month. Again, the jobs number, again, it's hotter than was expected, but it's less hot than the 500,000, and wage gains were a little bit muted. So, that means there's an open argument for either 25 or 50 basis points of rate increases later this month. So if we get to a point this year where we've gone through the last interest rate hike, what does that mean historically for stocks and bonds? And what this shows is going back to 1994, the average stock and bond performance 12 months after the last rate hike. So on stocks, that's up just under 20, and on bonds up 11.5. So increasingly, there are an odds of a recession this year. What we don't know is when and how much the market has already priced that in. Looking at the finished 2022, we had slight contraction Q1 and Q2, and then expansion Q3 and Q4. The consumer drives 70% of the economy, so how they're faring is something to closely monitor. You have seen debt service ratio on households pick up, so that's something to keep an eye on. You've also seen excess savings that peaked starting to burn off. So the estimated is that those savings rates burn off in sometime this year. So keeping an eye on that and how the consumer is spending is worth following. Another thing to think about is where money market assets are and what that means on forward stock market. So these are different peak times on money market assets, 4.8 trillion in May of 20 at the beginning of the pandemic. Today, we sit at about 4.8 trillion, so at about the same amount. This is a look going back to 1996 at the 3-year stock market performance after peak money market asset levels. So you'll see in other 3 peak cycles going back to 1996, that's supportive of stock prices going forward. And this is just a much longer view. You know, this is 97 years of history going back to 1926. And what markets have done, 71 up years, 26 down. We never know when the down is going to happen and what's going to cause that. And every one of these down years is painful to go through. But overwhelmingly, 71 of the 97 is up. And when it's up by average of 21 versus down an average of negative 13. We will be rebalancing in the coming weeks, and we'll be sending out trade notes as it relates to that in terms of the themes that we think are opportunistic going forward. So that said, we encourage you to contact us. None of this is a substitute for talking to us directly about how all of these things affect you. So please leave no question unanswered. Please contact us. So with that in mind, we close. We wish you and your families well. We hope to see many of you at our upcoming forum next month in April. If we can serve you in any way, please do not hesitate to call us. Until we see you again, be well and take care.